To create financial wealth, your business wants to be operating well, but you also need to make wise investment decisions and select options that give you positive returns. A useful calculation is return on asset. Paul, would you be able to take us through an explanation of return on asset?
Yeah, sure. So return on assets is looking at the relationship between the operating profit that your farm business is generating in relation to the assets involved. And so if you look at the formula, an operating profit is the profit that your business generates before we take into account interest, tax, drawings and capital expenditure. And the assets for a farm owner would be the land, livestock, dairy shares if they're involved, and plant and machinery. For a herd owning she milker, it would be the livestock and the plant and machinery.
Would you be able to take us through an example of working out return on asset for a dairy farm business?
Okay, so let's take a typical New Zealand farm of 150 hectares, and depending on where that farm is, it will have different values, but let's say that that farm has an asset value of $7.5 million. And for purposes of this example, we'll say that the operating profit that's being generated is $300,000. So let's put it into our return on assets formula from above. So we have return on assets, so we'll put the 300,000 on top of the equation, 300,000, we'll divide that by the asset value that went into generating that operating profit, which is the 7.5 million, and if we divide that out, that equals 0.04 or 4%. So that's a return on asset of 4% from that business. And one of the general rules of thumb in farm businesses, but also in any business or investment, is to try and achieve a return on assets of at least or preferably above the interest rate on borrowed money. And so you can see in this particular example, at the moment that's a little bit below that target figure.
If this business was to lift their return on asset, what changes would need to happen?
So as I said earlier, the 4% return on assets for this business is a little bit below the current cost of borrowing. So let's say they're trying to lift that. So how would they do that? Well, really we've got to try and lift the operating profit. And practically, how do you do that? Well, you either try and reduce your costs, or maybe try and lift the revenue. And so let's come up with a scenario where we try and lift the return on assets. And so in our example 2, we'll assume that this particular farm business has managed to lift profit by either dropping costs or lifting the revenue, and they're now generating operating profit of $450,000, which is an increase of $150,000 profit. The asset value is still the same of the business, 7.5 million. And if we do that calculation, we come out with 0.06 or 6% return on assets, which is a little bit more in line with the cost of borrowing, which is our minimum target.
What are ways that dairy farm businesses can use the return on asset equation for their decision making?
Okay, so let's say you were looking to purchase this farm business and you assessed the operating profit level that has been generated previously, and the 300,000 is, there's not much potential to lift that, so it's really operating at an optimum level. And let's also say that your target return on assets is 6%. That's your hurdle rate of return that you want to achieve. And so the way to work out what you could actually afford to pay for this business and achieve a 6% return is that you take the operating profit that you feel is possible from the farm business, so it's 300,000 in this scenario, And if we divide that by the return on asset that you want to achieve, so we'll divide that by 0.06 or 6%, and that comes out at an asset value of $5 million. If you purchase this farm for $5 million and you could achieve an operating profit of $300,000, that would lead you to achieving a 6% return on assets.
How can this calculation be applied to other businesses, Paul?
So really this type of analysis really is an approach that can be applied to any type of business, whether you're buying a farm, some support block land, whether you're going into your first she milking business, buying a rental property in town, or any other sort of business. So it's a very a universal approach that is applies across a whole range of investments and businesses. So return on assets is a very powerful and important calculation to do when you're analysing your own farm and looking at new investments. But always remember that it's only one criteria, and depending on your personal situation, and your goals, there will be a whole range of other criteria that you need to assess before you make decisions about running your current farm or making new investments.